Hi. So what I thought I would do today is go through financial planning mistakes. People try to keep separate things separate, and then they find out later that there are consequences. So what they thought they were doing was right on day one, they find out after the fact that there's a ripple effect creating problems. And this is involving health insurance, more frequently. I'm seeing this more and more through time. It's going to get more complicated because people are working beyond 65 years old and the rules are changing. CARES Act, you don't have to take RMD, number of different balls in the air. And ultimately, these things involve taxes. So what ends up happening is all these things kind of get mixed together. And when you try to pull them apart and think of them separately, you don't think through the fact that there's this interaction. And that leads to problems. I'm going to try to help you prevent those today. And we'll go through a number of different topics here on, why this kind of thing occurs. Now, the fact of the matter is that, this is just one of many videos. And I encourage everyone to subscribe to the channel and look through the videos because I talk about a wide variety of different topics. And, a client was nice enough to say, Jay, your toolbox has a number of different components to it. And that's necessary, right? Because life is complicated, and I get that. And I try to reach out to as many different types of people listening through different types of media as you can, whether it be here on YouTube, podcast. There's a newsletter if you are a person that likes to get emails directly into the inbox. And there's always the website, www.maximizeyourmedicare.com. You can go there. There's a button there right on the front page that you can click the hashtag AskJ. Send me your private question. So I'm going to be talking about these topics as they relate to health insurance or Medicare, and this is just the starting point. This isn't the complete private solution. For that, I'd have to know a lot more about you. I'm dealing with this every single day these days, it seems like, and it's becoming more and more frequent, a point I just made. So let's start with health savings account. What is a health savings account? For health savings account is a separately owned bank account. Okay. In there, what you can think of it is as a health related IRA, meaning you can contribute to your IRA, your health related IRA, your HSA. And there are limits, and there they are there on the slide. $3,550 for an individual, $7,100 for a couple. And there's this catch-up provision if you are 55 or older. Well, in order to be able to open one of these, you need to have a very specific type of health insurance, and it's called high deductible health plan, HDHP, as you can see there on your screen. And what these plans are is you need to have one of these health plans so that you can open an account. Now, let's say in year one, you had one of these HSA accounts and a high deductible health plan. And then in year two, you switch to a non-qualifying plan. Can you do this? Yes, that bank account is yours. All right, that is a privately owned bank account. So let's say you deposit money into it. What can you do with it? You can pay with health-related expenses on a pre-tax basis, right? Because you've deposited money on day one and taken a tax deduction. When you pay for it at the counter at Walgreens or something or your pharmacy, you're paying for it out of that account. So basically you're paying for that prescription with pre-tax money. And, all of these types of HSAs, they generally speaking, they allow for direct payments. They also can send you, a debit card that you can use at the counter. What some people don't understand is that if you itemize, this can also include some big ticket items. It's not just for Tylenol. It can be your health insurance premium. For those on Medicare, that also means Medicare Advantage, if you have a premium, your Part D plan, standalone prescription plan, and Medigap. That also means Part B under Medicare, including IRMAs, right? Because that is your health insurance premium. Last point there on the slide is that lots of people don't consider it as far as this goes, but it is also allowed. You can use the funds inside your HSA in order to pay for long-term care insurance premium. So yes, you can pay for long-term care insurance with pre-tax dollars. Now, very important caveat here, which is this is for persons that itemize deductions, right? Only those persons that can itemize deductions. And there's an official list of all of the things that you can deduct, and it's called a publication 502. The link is here at the bottom of the page. That all said, HSA has its problem, or it has this little kind of peculiarity. So what happens is, let's just say so the main problem is the following, which is you cannot be enrolled in any part of Medicare, Part A or B, and make personal contribution to get the tax deduction. Now, some people, their employer makes the deposit. That is not what I'm talking about here. This is, you can't take your private money and deposit it into an HSA and at the same time have the federal red, white, and blue card. You can't have that combination. The rationale being is, look, you're already getting a tax favorable situation due to the fact that Medicare is paid out of the federal budget. So now you're also taking an extra deduction. I mean, I'm not an accountant, but I guess that would be the rationale. And don't get me wrong, by the way, that is under some debate. I have seen proposals to make that no longer the case. As of now, there still is this limitation. You cannot have your federal card and have an HSA account at the same time. Can't be done. So this leads to some very specific, quirky problems, right? And here it is on your right-hand side of the screen. So now let's just say you're beyond 65 years old. Let's call yourself 67 years old. And you decide to retire on October 1st or the end of September, right on that date. And you have an HSA account. Let's say you correctly deposited 9 months of HSA contribution, right? 3,550 times 9 divided by 12. Okay. And that's what I just said, right? Which is, since it's month by month, that is the most that you can contribute, given the fact that you have going to retire on October 1st. There's an extra detail here, which is, since the rule says that you can't have any part of Part A or Part B and contribute to an HSA, when you enroll in Medicare at 67 or beyond 65, your Part A coverage date will start 6 months prior to April 1. Now what? Now you see the problem, which is you deposited 9 months, but you're only really supposed to have been depositing 3 months. You've deposited 6 extra months worth, and that is a tax penalty that subjects you to a tax violation. And so only if you watch this video candidly, this is a point that almost nobody makes. It's there in the book in Maximize Your Medicare, available on Amazon. Anyway, the fact is that this guy can create an issue, even though you really haven't done too much wrong. It's a special quirk, but you do need to, just an example of one of the samples we're going to go through, of which is the first one, which is under HSA. So let's take a look now at Roth conversions. Okay, so a Roth IRA, many people understand the term. Money can go in there. You can either contribution, or you can convert from a tax deferred account, a 401k, for example, or a traditional IRA, and convert into a Roth IRA. Now, the reality is that I'm not talking about a contribution, because that is with post-tax dollars. Okay, that is not going to be affected here. However, conversion is different, and it's important to keep them separate and distinct because of this. And unfortunately, in the media, people just kind of say, okay, well, Roth IRAs are great, and because you're deferring taxes until later. Yeah, but they're handled differently, and we'll go through it here. So the conversion, like I said, you're taking money from qualified funds, which can either be, for example, 401k, 403b, for example. Okay. You can convert up to $7,000 a person per year, $14,000 for a household. What ends up happening is the information you read generally are just say, okay, well, you pay tax now because you're, and then they gloss over, they glide through that. The issue, though, is the mechanism that creates the tax is the fact that you are recognizing income. Now you can see, much like HSA, what has happened, and with a particularly ugly twist coming up over on the right-hand side of this slide, right? Which is, so now let's just say you have converted $14,000 conversion into a Roth IRA. The issue is that you now have $14,000 extra of income, and that can trigger IRMA, which is higher Medicare Part B and Medicare Part D premium. So you can understand the point here, which is, and this is even beyond the debate of whether or not a Roth IRA actually does work out for you if you convert, right? Because that presumes that the tax rate's going to be higher. And, I said I had a see me after class in the newsletter on another video where famous celebrity says this is a no-brainer. Do you really think that tax rates aren't going to be higher 5, 10, 15 years from now due to all the debt that we have taken on? We could have said the same thing 10 years ago, right? Rates aren't higher. So let's not, you see what I'm saying? So what ends up happening is people just gloss over the assumptions, right? What do we assume? We assume that, rates are going to be higher. Okay. Even if it were true, now you've got this other question about how to deal with the income tax implication. The second ripple effect can be even more expensive, which is that many people don't understand that if you're on the Affordable Care Act and you've received a subsidy for your health insurance premium, and this is in Medicaid expansion states, then what you're actually doing is you're getting a tax credit. You're getting an income tax credit. And they use your income in order to determine how much that credit will be. So let's just say a married couple, 63 years old, converted $14,000 to Roth. Well, let's just say, and for them, health insurance can easily be $1,500 a month for the couple, easily, right? And if you live in Florida, I've got the wrong first digit as far as how much it is a month. That's true. So let's say out of this $1,500, they got a $500 a month subsidy. And on November 1, they make the Roth IRA conversion from 401k from their prior job. Rollover 401k. So in doing so, by taking the $14,000 extra income on November 1st, they've got to report that to the IRS. And let's just say they forget to do it. And even if they did do it, the issue is that their APTC drops. And let's, for this example's case, instead of $500, let's say that they're entitled to $300. So that $200 difference, the difference between $500 and $300, which is $200, they have to pay it back for all 12 months. 12 months times 200, $2,400 is what they'll have to pay back. So yeah, so what happened when you did your Roth IRA conversion? You paid tax on your $14,000. You also paid $2,400 more in income taxes. Now your hurdle rate on, oh yeah, defer taxes and take your taxes now because tax rates are going to go higher later. A, that's not 100% certainty. And B, now the amount that you've got to beat has risen by $2,400. This is pretty big. Let's now go to the last slide, last example, and they're kind of the same. They're related to one another, and they have to do with Social Security and required minimum distributions. So all over YouTube, there is always the question of, when are you going to take your Social Security? When are you going to start receiving your Social Security benefits? Okay. And I'm not going to go through the ins and out about the way that I think of it. Not for these purposes. This is specifically about the tax implication and whether or not it affects health insurance premiums or Medicare premiums. And actually, Medicare is health insurance, it's just a specialized type, isn't it? Anyway, so under Social Security, it is the one instance that where an extra factor does fall on the side of deferring your Social Security, right? Because even if you have the Social Security income later, are you pushing off IRMA potentially? That is possibly the case, right? Not claiming income now, which is kind of the reverse of the Roth IRA conversion, right? So by not taking income, you are possibly pushing off your IRMA or not qualifying, especially because of the fact that IRMA, the brackets are going to increase along with inflation. Okay. So you're going to have a tax person, because you need to understand that, all Social Security is not taxed, right? It's not counted toward taxable income, not all of it. So it's not up to me to actually put this or say, this is absolutely positively worth it. This is a layup. This is a no-brainer. You don't hear me say that very often, unless you're giving away a free option. Then I'm going to say it. But outside of that, this requires some thought by you, right? I mean, okay, I need my Social Security benefits today versus, okay, I may be faced with IRMA if I go over the bracket, which for a single person, 87,000, for a couple, 174,000. It can be an extra reason to defer your Social Security benefits. In the same way, required minimum distributions. So now the Secure Act, which was pre-pandemic, you don't have to withdraw from qualified funds until the age of 72. Okay, till 72. And this year, because of coronavirus, what ends up happening is you don't have to take an RMD at all, period. Okay? Another reason, if this money doesn't get used for food, if it's not used to pay your monthly bills, it is something to take a look at, right? Because not only are you not paying income tax this year, the problem with the APTC, right, may go away. Now, the APTC, and my point here is it's not only required minimum distributions, but it's also distributions from your qualified funds. So you can be pre-Medicare. You might think to yourself, okay, Jay, you're talking about RMD, I'm 72. Not necessarily, right? A 64-year-old has the same thing, which is I need $10,000. Am I going to get it from my qualified funds or non-qualified funds? You want to be careful here when pulling money from qualified funds because of the income tax implication. Because of the fact it could either be used for RMD later when you're on Medicare, or it can it can result in you having to pay back your APTC for the entirety of the year. You need to be careful. And this is my central point, right? I mean, you can see the common fact is people are taking a look at each one of these topics. We're going to get to one more. Right, we're going to get to one more, but each one of these topics as separate entities. They're not separate entities. They're interdependent on each other. Right? There's an interaction across these different, seemingly different topics. The last one is for some of you who have some of your holdings in mutual funds. So you can understand if you are a seasoned person in investing or have been invested in mutual funds that a lot of money has left the mutual fund industry for exchange traded funds or ETFs. And there are a bunch of different reasons for that. And I'm not going to hash that through. That's the subject of a 5-hour YouTube video by me later. That's not for today. But one challenge is no question true, and many people have seen this firsthand, many, which is that under qualified funds, pre-tax money, mutual funds distribute money in a peculiar way, which is part of the controversy, right? Which is that they distribute capital gains and dividends kind of at the end of the year, at fourth quarter, generally speaking, and some make periodic on a quarterly basis. But my point here is that it leaves you without real knowledge about what the possible tax implication is. And lots of people just say, okay, well, we're going to get your capital gains tax distribution. Do you want to withhold from tax? So it becomes opaque to you. Yeah, but remember the prior slide. It changed your income tax. So as a result, it could also ripple through back to IRMA and back to your APTC. And this is particularly challenging because you don't actually know until the fourth quarter. And then it may be too late to make changes. This makes it very, very challenging. And it's just another one of these issues that what ends up happening under mutual funds. So I just said about qualified funds. Under qualified funds, it doesn't matter, right? Because all that money is pre-tax. But if you have mutual funds in your non-qualified funds, that's different. That becomes taxable in that tax year because, that is post-tax money. So now what you end up having is this distribution problem, cash flow distribution problem, where you're getting these capital gains or you're getting your qualified dividends, which will be taxable, which will be reported taxes. So now you can understand it. You're doing your taxes at the last moment in 2021. You think, okay, well, I'm not going to really owe much for taxes because I've already withheld tax from various sources. And on my mutual fund distributions, I withheld tax at the mutual fund company or at the brokerage. I gave my, advisor to do this. However, if you hadn't considered the APTC, haven't considered the fact that in a couple of years, you could be hit with IRMA by putting yourself into the higher tax bracket, now you've got a problem. And so it's so big, in fact, and the money's significant, right? I mean, because you're talking about if you've got to pay back $2,400 on a $14,000 Roth IRA conversion, you're talking about a lot of tax compared to the denominator of $14,000. It's hard to make back up $2,400 on $14,000 of investments, right? Take a look at this year, just for example. The fact of the matter is that, the common message is what you have in the world, the way that we work, our society, like I said, is you go to one person number one for topic A, and you go to person number two for topic B. The problem is if you don't have a quarterback who understands at least the radar has to be on to know that there's an interaction here. I'm not going to apologize to you the fact that I'm bringing this up to you, right? I can't control the persons that you've met in the past. I know my persons don't face this. Why? Because I'm at least, cognizant of the fact that these things exist, and I need to call a CPA to get, precise numbers on exactly what the tax implication might be, so that this thing can make changes if required. This can affect, and like I said, the ripple effects are so serious that it changes every bit of the rest of the puzzle. And so again, that's what my common message here. And you're going to see me use this slide in this form on multiple occasions, which is, this is that situation is that, yeah, you thought you were talking to somebody about Roth IRA conversion because that's your, IRA expert. But if they don't have any idea about how health insurance works, now you're out $2,400 in that example, right? Awfully hard, $2,400 to get on the $14,000. That's it for today. Please subscribe to the channel. This kind of interaction is going to happen more and more and more. It's obvious. People are working beyond 65. There are efforts, and they're not necessarily wrong, ill meaning and things like that, right? Meaning that APTC and helping people towards your to lower your health insurance premium, what can you really say? That is not a negative thing. That looks like financial assistance. That said, if you're not handling and thinking through these interrelationships, you could be missing out, and you could be missing out something big. Hope you enjoyed today. Well, enjoyed. Hope you got something from today. That's what I'll say. And please subscribe to the station. Hope you enjoyed today, or you got something for today. I should probably properly say, right? Be sure, go to maximizeyourmedicare.com, press on Ask Jay with your questions, or leave your comments below. I'll be sure to answer within 24 hours. Thanks for watching.